Fed isn't going to be the party pooper. Gold are sensitive to rates. And certainly real rates in particular, if those are going to stay higher, where they are, go up, then gold typically would not benefit from that. It's going to take a lot for oil to go back to the 100, 110 where it was, a few months ago. Rates going up 50 basis points is just not going to change much for, AI related spending. Most of that is equity financed one way or another. And if there is borrowing, it's going to happen either way. You would only see gold maybe getting another tailwind.
Everyone's talking about market frothiness, but what would actually put an end to this bull rally in stock markets? Well, we're here to discuss this with Sam Burns, Chief Market Strategist at Mill Street Research. Sam has been looking at what's been driving the markets and the economy overall, and it really boils down to one or two things. And so if these things stop growing, then logically speaking, the rest of the economy stops growing. And what happens to the Federal Reserve? What will they do this year? How high will interest rates go? This will affect everything from your credit card loans to your car payments to potentially how the stock market will behave. We'll find out what's next with the Fed and the indicators they're looking at. One of them is inflation. And traders right now are predicting that there is a greater chance that inflation will be lower rather than higher in the June print. According to Kalshi, the largest prediction market in the U.S., inflation is going to be right above 3.8%, above 3.7%, but not as high as the current 4.2%. Right now, there is a 65% chance that the June CPI print will be above 3.7%. And so we'll get Sam's take on where inflation is headed. Maybe it'll cool off a little bit. Who knows? We'll find out. This episode is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my code LIN, L-I-N. New users who use my code LIN will get $10 when you trade $10. And like I showed you earlier, right now, if you're trading on the inflation in June 2026 prediction, if you're placing $50 down on above 3.7%, you could get a payout of $72, $73 if you turn out to be right. Sam, welcome back to the show. Good to see you.
Hey, David. Thanks for having me.
I was reading the other day that most of the S&P 500's gains were from AI-related companies. And if you take out that sector and related companies, actually it's flat on the year. Is that something you looked at as well? And if that's true, I wonder what that says about investing. Maybe we should just go into tech companies and avoid lagging sectors.
Yeah, I've seen stats like that there's definitely been the big driver of equities has been the sort of tech and adjacent sectors that are sort of somehow tied to AI, which could include industrials. So there's a few utilities. There's a few, all different kinds of companies that are kind of part of that whole ecosystem. But yeah, I think that's been the big driver. You can see it in the economic data, you can see it in the earnings data, and you can see it in the stock market returns. That's definitely been the big driver of corporate earnings growth and of market gains. And I think it's one of those things. It's great as long as it lasts. I think there's been a little more focus on the kind of the sustainability of the AI business model itself lately, which is going to raise some questions about how many hundreds of billions of dollars these companies can continue to spend on kind of capex and the related expenses to run all this. And that's the question I think people are going to have to face over the next year or so.
But do we know if this bubble, if we want to call it a bubble, is going to pop anytime soon? Just because something is frothy or looks expensive per traditional valuations metrics, it doesn't mean it can't go any higher, right?
Oh, absolutely. Yeah, I know these things can go on much longer than people anticipate. Certainly those of us who were around in the late 90s remember, Chairman Greenspan talking about how he thought that, stocks were showing irrational exuberance in 1997. And then it wasn't until early 2000 that he actually had the real peak in the stock market. So there's definitely, not a good timing, precise timing aspect to this. It's just a question of, and certainly you can have speculative periods and then, maybe there's a correction and things kind of go sideways for a while and then it picks up again. It doesn't have to be a monumental crash that happens, after a period of kind of frothy behavior. So and I think the fact that you're seeing, a lot of companies starting to issue more equity means that they see some of the valuations here as being pretty high and therefore favorable if you're issuing equity and maybe less so if you're the one buying it. So I think that's the kind of, situation we're in now, the fundamentals are pretty good. A lot of these companies are earning lots of money, but it's going to be hard for it to continue at this pace for much longer. And the question is, if it does even slow down, even if it doesn't stop, is that going to be enough to kind of trigger a response in the markets if expectations have gotten too high?
What is your expectation for how this will progress?
My guess is that there's going to be more kind of what we've seen lately is a rotation where, one segment will lead for a little while and then something will shift and then another segment will lead. For a while it was, of course, the Magnificent Seven. That was the big dominant, the leadership. And now they've actually been lagging for a number of months now. They've been underperforming because a lot of them are the ones that are spending the money, whereas the ones that are making it are the hardware makers, the memory makers and hard drives and things like that that have just been going absolutely through the roof, and with some good reason in the sense that their earnings have been also going through the roof. So you've got definitely a shifting sort of winners and losers, and so I think as long as you can kind of stay on top of that, then it's fine. I've been overweight technology for many months now, and still am. That's where a lot of the earnings growth still is. So it's definitely the strongest area of the market in terms of the fundamentals. But my concern again is that you can price, you can overprice anything or get your expectations too high. And I think the question is if the earnings estimates themselves, which are very good right now, get to be too extreme and have to slow down, is that going to provoke a more negative response if there's a lot of leverage in the system, which there is right now. A lot of leverage, trading has been going on. People have leverage positions in a lot of these names, and that can unwind, quickly as in the same way that it's gone up quickly.
Are you a little surprised that rising yields and higher inflation expectations, as well as higher geopolitical tensions all throughout this year, these things have not collectively caused the stock market to crash? Does that surprise you?
A little bit, in the sense that I think there are a lot of other times historically when if you'd had these same inflation kind of conditions, you would have seen much more of a negative response from the market. Now, part of that is because normally the reason inflation is a problem for stocks is that it causes the Fed to raise rates. Inflation itself is not really bad for stocks, at least relative to bonds, because corporate earnings go up along with inflation. Companies just pass along those price increases, and so their profits will go up. The problem is if the Federal Reserve raises interest rates aggressively as a result of the inflation, then that makes owning stocks less appealing. It tends to slow down the economy. But so far, the Fed has not done that and has not really indicated it's going to do that. That's really the difference this cycle, is the Fed was lowering rates until December and has been basically just sitting on the sidelines for the first 6 months of this year and probably will for a little while longer. So if the Fed isn't going to be the party pooper, then inflation is it's not great. Consumers don't like it, but the stock market and earnings aren't necessarily that bad or any worse off. They can get some pricing power out of it. So I think that's been the real difference this cycle. The fact that, and also the fact that people see that the inflation is coming from, like the war in Iran and a supply shock to oil, predominantly. And then prior to that, it was, the Ukraine and COVID and everything else. So if you know the reason for it and you think that reason will go away fairly soon, you don't worry about it as much. And that's what I think the market's been doing.
I think that leads me to my next question, which is inflation, the core driver of what the Fed is looking at right now, arguably more so than the labor market. We'll talk about that in just a minute as well. This is from Kalshi. It's a prediction market. Inflation in June 2026. I'll read you some of the predictions in just a bit and the probabilities, but here we have the 12-month CPI inflation rate, currently at 4.2% for May. Now, June, the prediction for June is interesting. 99% think that it's going to be above 3.1. Okay, that makes sense. If you actually look above 4.2, how many people think it's going to be above 4%? It's actually 5% probability. The majority, 95%, think it's between 3.6% to 3.9%. Either of those numbers are going to be lower than the current 4.2%. So basically, traders are predicting that inflation will cool off somewhat in the next June print, which is coming out in a couple of weeks. What do you think?
Yeah, no, I could certainly see that happening. Certainly with oil prices having come down in the last month or two already, if that's going to be the big swing factor in the headline number, which is what these numbers are, rather than kind of the core rate. And And so I think there were some other factors that are probably keeping the CPI up a little bit lately. So I think, yeah, we could see a little bit of slowing from the 4.2% rate, which is, pretty high for as these things go, in the next month or two. And I think that's also, yeah, probably what the Fed is thinking is that if things even slow down some, even if they're still above target, that's at least, a sign of improvement and maybe a reason to stay on the sidelines a little while longer.
How likely is it that oil will stay lower?
Yeah, I mean, a lot of that, of course, depends on how things go with, negotiations with Iran and all the other, kind of countries in the Middle East there. If they manage to kind of keep oil flowing through the Strait of Hormuz or otherwise, then I think it could, easily stay, kind of in the $70 a barrel range where it's been lately, or even go a little lower. If war breaks out again and the strait is fully closed like it was, earlier, then you get another rebound back up to, $80 or $90 a barrel. My guess is that it's going to take a lot for oil to go back to the 100, 110 where it was, a few months ago. I think, there's been, kind of enough ways for oil to get where it needs to go, that it won't go back up that high unless something really shocking kind of happens in terms of geopolitics, which at the moment does not look likely. So my guess is that there's plenty of oil around. It's just a matter of whether it can go through the strait or not. Demand is starting to decline, or has been declining for a long time and still is. So my guess is that we probably won't see $100 barrel on oil again soon, but it may not go back to the 50, 60 where it was prior to the war.
It's interesting how the ceasefire agreement between Iran and Israel and the U.S. Lasted about a couple of days 2 weeks ago. During that time, oil went down to $71 a barrel. But Iran has been accused of breaking the ceasefire by the Americans, the Israelis, and oil hasn't come back up. Just in the last couple of days, 2 oil tankers were struck in the Strait of Hormuz. Why do you think the oil markets are not reacting to the upside?
Yeah, it is a question. We wonder, whether I guess part of it is that there's a view that oil is finding other ways to get to where it needs to go besides the Strait of Hormuz. And also that, again, that they think this is all kind of temporary. It'll get worked out within a few weeks. And that actually the inventories of crude oil globally are higher than maybe what people had expected, particularly in China, where it looks like they had built up quite a large stockpile of oil and other, petroleum products before the war started, and have been running it down and cutting their demand for imports pretty drastically, which has helped keep the market in balance more than I think a lot of people anticipated. So I think people view that there's enough inventory still around to get us through however long, a few weeks or another month or two before, oil really starts to kind of flow properly again. So maybe that's an optimistic view, but I think that's what the market's view is that there's still a sort of a shorter term thing. There's still a lot of inventory of oil around, and it's just a matter of kind of the hassle and cost of getting it to where it's supposed to go. It's higher. It's hard. Shipping costs are higher now, things like that. But there's still oil to be found if you need it. And so that's why they're not pushing up, futures prices as much as they did before.
Are we seeing any evidence that the higher oil prices have caused core goods, core CPI and core PCE to go up and stay higher? So basically goods outside of energy, have they gone up because of the war in Iran? And can we expect inflation outside of energy and food to continue rising?
I think there has been probably some kind of bleed over into the core. Some of it is the kind of cost of transportation. Secondarily, it's things that like in the material sector, plastics and things like that have gone up in price due to the supply disruption. So I think there are kind of knock-on effects that are still to be seen. Some of them are going to have smaller effects on the overall CPI, and core rate and things like that, just because they're just not that big a percentage of spending. And I think that's what people realize about energy in general, that the cost of sort of, what the average consumer spends on gasoline and other oil products just is lower than it used to be historically, even 20 or 30 years ago. And so the impact on inflation or on kind of, consumers' pocketbooks is not as dramatic as it would have been, at various points in the past. So I think there probably is still some impact coming through. There's probably still some lagged impacts of tariffs and things that have not shown up yet. But those are all things that are going to fade over the next 6 to 12 months. And so the question is there a policy response coming to that? If there's not, then it's not that big a deal for financial markets, and will eventually kind of fade away for consumers. So I don't think prices go back down; they just stop going up as fast.
What do you think are the most important data points and events in the Fed's calculus right now?
I think the Fed knows that inflation is too high. I think they're hoping, or at least predicting, that it'll go back down. And then the labor market, was the big factor end of last year, that was potentially going to provoke a rate cut if they thought that the labor market was going to slow down further than it already had. I think so far it looks like the labor market is actually holding up better than expected. The consensus that there's a jobs report coming out this Thursday, since there's a holiday Friday, it's looking like it's probably going to be pretty decent, in terms of job growth and the unemployment rate. So far it looks like there isn't really a reason to be concerned about the labor market. Unemployment claims have stayed pretty low. The number of jobs and the unemployment rate have stayed pretty moderate. Even with the immigration, related changes. So I think the Fed doesn't really have any reason to, certainly not to cut rates. And if they did to do anything, it'd probably be to raise rates, a little bit. But my guess is they're going to try to put that off as long as they can. So I think they're going to just sit on the sidelines and wait and hope that some of the geopolitics calms down a bit. The other factor is, of course, that AI is causing some inflation itself, outside of oil or tariffs and things. And I think they're trying to figure out what to do about that, both in terms of tech hardware, but also things like utilities and electricity prices.
Overall, then, how do you think Americans' living standards will change over the next year?
My guess is that the average consumer is probably not. It'll be okay, but it won't be much growth or improvement in living standards. I think inflation is going to stay relatively high and be sort of somewhere close to what wage growth will be. I think right now, real, inflation adjusted disposable personal income growth is about zero year over year. So there's basically been almost no increase in real disposable income overall. Spending has actually been positive, real spending growth, because people are basically saving less. They're spending more of their income than they did before, running down savings or saving a lower percentage of their pay. Some of that is just consumers, saving less, and some of it is, of course, higher income consumers spending more of their stock market gains. Of course, stock market's been doing very well. The real estate market certainly over the last few years has done well. So if you own assets, stocks or houses, or real estate, you've got plenty of sort of equity in those things, assets you can borrow against or sell to spend. And I think people are doing that. And I think that's what's holding up spending over and above what income growth has been. So I think income growth is probably going to be pretty modest after inflation is accounted for, but spending may hold up a little while longer, particularly if the tech AI spending goes on for a while longer.
Do you think, though, that wages will keep up with inflation this year?
I think they'll be close. I think there's still enough demand for labor around to keep wages from wage growth from falling too much. But I think it's going to be, for a while, wages were just sort of pretty clearly outpacing inflation. Now I think that sort of gap has gone away. Now you're getting wage growth that's more or less in line with inflation, but not really any better than inflation. So I think it'll be sort of a struggle to get a lot of real income growth for the average consumer.
One thing I've noticed is that retail sales, according to the latest data released earlier in June, showed that it grew 0.9% month over month, which is the fourth straight month of gains. It's up 7% year over year. I wonder who's doing the spending then if the consumer's health isn't improving. Overall, then, would you attribute the higher retail sales spending to higher inflation, and so the cost of goods is more expensive, or higher volume of purchases overall? Do we have any data to indicate either of these?
I think a lot of that sort of nominal growth that you mentioned is inflation. I think there's definitely that 4% or so, CPI, at least is coming through in retail prices. So I think there's a good chunk of that is inflation. And again, the other part is going to be higher income household spending, both income and sort of capital gains effectively. Is holding things up, and so that falling savings rate is helping kind of boost consumption and spending over and above what income growth, just kind of wage growth by itself would support. So if you look at the chart of the personal savings rate over time, it's way back down to where it was kind of the lows of 2022 and well below where it was for most of the period prior to COVID. Kind of the normal rate was probably 5-6%, and now we're around 3% saving rate right now. So I think that's a big chunk of it too, is that people are just spending more of their income either because they think their income is going to grow and they're optimistic, or they've got income from other sources besides just wages that they're able to spend and want to go out and spend it now.
The notion that interest rates will rise, how does that impact not just the stock market, but also consumers?
I think for the stock market, it's probably a pretty mild impact just because I don't think anyone really thinks rates are going to go up a lot. I think maybe you get at most 2 quarter-point rate hikes in the next 6 to 12 months from the Fed. And if that's really all you're looking at, that's just not that big a deal. The yield curve has already steepened a fair amount from where it was. So some of that is to some degree priced in. The 10-year yield is higher than Fed funds, noticeably now. So I don't think there's a lot of risk that people think rates are going to go way up. And therefore, it's just not going to have a big impact on the market. And particularly because a lot of the things that are holding up the market, the tech spending is really not sensitive to rates. Rates going up 50 basis points is just not going to change much for AI related spending. Most of that is equity financed one way or another, and if there is borrowing, it's going to happen either way. It's not really going to be affected much by a small change in rates. Consumers might feel it a little bit if the rates go up, but again, rates aren't that high right now, and another 50 basis points at most just isn't going to move the needle that much. Particularly because the private sector consumers are not that highly leveraged. They don't have a huge amount of debt relative to income or assets in aggregate, like they did, say, in 2005, 2006, for instance. So the impact of rates is less just because people proportionally have less debt in aggregate than they used to. And so same thing for corporations. Big companies just aren't carrying a ton of debt relative to their assets. So rates are just not that big a swing factor relative to past cycles. So that's why I'm less concerned about rates and more concerned about if people decide that all the capex and investment spending that's going on for tech and AI isn't going to pay off at some point, and that slows down, then there's that chain reaction of everything else that's coming from that slows down as well.
Overall, then, this year, what would you say are probably the highest priorities for investors wanting to rotate their capital out of whatever they're in right now? In other words, the biggest movers that you think will shape markets in the next 6 months?
My guess is that, the tech space is still going to be the driver of what happens in the market. The sort of tech, AI, and then kind of the adjacent areas, and then kind of everything else. It's almost 50-50 in terms of market cap weighting in the S&P nowadays, in terms of if you include all the kind of tech-related companies now. So I think if you want to, have something that's not exposure to, kind of that tech space, I think some areas in, like things like healthcare, some parts of financials, and some parts of industrials, look, pretty good. And I think those are probably areas that you would want to have as part of your portfolio, so that you're not entirely exposed to technology. Because either way, you're probably going to get more volatility in that tech AI space, even if they go up. You're just going to have a lot of risk in your portfolio. So you want to definitely keep some exposure to it for now, because again, that's where the earnings are coming from. But I think the maybe call it the easy money part of the cycle is past, and you're going to get into the kind of the choppier, more volatile part of the kind of market cycle coming up in the next 6 to 12 months. And so I think, your portfolio needs to be ready for that. You need to have, a little bit of, whatever hedging or ballast in there, whether it's cash and bonds or whether it's just other sectors besides tech. Because right now it's basically been, tech goes up and everything else goes down, or everything else goes up and tech goes down. So that's kind of your main portfolio construction concern right now.
The anti-fiat assets, if you want to call them that, Bitcoin and gold, have corrected tremendously from the tops already. Any rotation into those spaces you see as being potentials?
My guess is probably not at this point, simply because to some degree things like gold are sensitive to rates. And certainly real rates in particular. If those are going to stay higher, where they are, go up, then gold typically would not benefit from that. You would only see gold maybe getting another tailwind if rates were going to go down, if the economy really slows down substantially. Bitcoin kind of, moves on its own. It's more of a, traditionally more of a risk asset than a hedge against anything. It's been under pressure lately just from supply demand, I think. I've always kind of struggled to see the real investment case for it. And I think the fact that some of the factors like the, MicroStrategy or strategy, the big owners of it have been selling or at least not buying anymore. There's a lot of kind of sentiment factors going on there and supply demand. I don't think it's going to have a big boost, given that basically all the tech AI stuff has kind of taken the attention and the kind of the speculative money has gone away from those alternative digital assets that they used to get a few years ago. That now people are more interested in some of these tech AI related stuff rather than Bitcoin and things.
This is also from Kaushi. Recession this year, 10% chance. So most people don't think there's going to be a high chance of a recession this year. So let's talk about the labor market. A recession is defined by many things, but most importantly, if unemployment goes much higher and people start losing their jobs, then we can call it a recession. The labor market is showing signs of strength. Last month added 172,000 jobs, according to the latest non-farm payroll report. But it's also showing weakness on the edges. The unemployment rate is at 4.3%. We have the jobless claims climb up as well on the back of actually more non-farm payrolls being added. So they're kind of conflicting messages. But more or less, I'm trying to get at is, what do you think is going to happen to the labor market throughout the year? And do you agree with the notion that there's going to be a small chance of a recession this year?
Yeah, I'd be surprised if there was a recession this year or in the next 12 months. And you're right. Yeah, the labor market, it really, looks like it's holding up pretty well overall. And I think the weak spots are going to be the kind of youth unemployment, the 16 to 24, whatever, that kind of young area, people in school, kind of coming out of school, has been tougher than kind of for, the kind of, what they call prime age, 25 to 54-year-old age range has been holding up quite well in terms of, employment rates. So I think overall it's pretty solid, but there are some areas where it's slightly weaker now. But I think because immigration is down, there's still, enough demand for labor to keep the unemployment rate itself, relatively stable, at least for a little while longer. And so far, I don't see any reason to think that that's going to shift, suddenly, unless there's some other, shock event to the system or major policy change. So I think there could be a gradual, weakening, but nothing that would be to the level of a recession in the next 6 to 12 months.
It's interesting how the chance of a recession climbed from 12.5% to almost 40% over the course of over the course of February as the Iran war broke out. But then the probability slowly and surely dropped over the last couple of months as the Iran war progressed. What do you think traders looked at that convinced them that the Iran war wasn't going to cause a major economic contraction?
I think a lot of it came down to the fact that people assumed that Trump was not really going to pursue this war, kind of on a long-term basis, that he was going to look for a way out and a way to sort of end the war and to get oil flowing again. I think that the perception was that this was going to be a shorter-term event. And therefore, it was not going to last long enough or be big enough to push the economy into recession just because of oil prices. The way this was not going to turn out to be like the 1970s, where an oil shock push the economy into a severe recession and, terrible inflation and interest rate rises and all that, that this was not going to be anything like that, in part because, like I say, Trump had very strong incentives to resolve things fairly quickly, and therefore there was not enough of that to push the economy into recession. And there's a countervailing fact of all this tech spending and AI and everything else that is helping the economy grow, and that really didn't have anything to do with oil or energy costs per se. That could happen, whether oil is $50 a barrel or $100 a barrel, really makes very little difference to all the data centers and the tech spending and so forth. And so if that's really where you think the growth is coming from, and then you look at the oil in Iran, it's just much less of a factor than as long as you don't think it's going to go on for a really long time. And so far, at least, that seems to be sort of what's playing out, even though there's a lot of debate about, whether the oil market itself is really in as good a shape as the, futures market make it look, that there's still probably some bumps to come there. But overall, it's just not as big an economic impact as people initially thought. And it wasn't going to go on as long as people were worried about. That the war was not really going to be as big an event as it looked like in that sort of first few weeks of it.
And do you agree with that trend?
Generally speaking, yeah, I think,
Do you think this trend will continue? Yeah, meaning, do you think the trend of this impact being relatively benign on the economy, do you think that'll continue? Or do you think that the worst is still ahead for us?
Yeah, I think that the net impact on the overall economy from oil prices is lower than people initially thought. I think that's still true. You look at the percentage of income spent on oil-related products, relative to total spending, and it's near historic lows. So even with a bump, it's still not even going to be back to where it was, say 10 years ago. My guess is that unless oil, there's a much bigger shock than what we've had, the oil impact is going to be pretty moderate. I think it's very salient in the sense that consumers notice it, and it affects political polling and it affects, the news headlines, but the actual net economic impact is just not that big, and certainly smaller than all the other factors going on, like both tech, but also, just federal deficit spending is enough to kind of keep enough, money printing going on to keep things going. So, I think there's going to be some inflation pressure, not just from oil, though. I think from other factors as well.
Do you see any things that will experience deflation as a side effect of what's going on right now in the Middle East? For example, I've been reading that used cars and trucks have actually gone down in price. Anything else?
Yeah, they had a big sort of increase, I guess, a little while ago after the tariffs and everything. So yeah, they probably are due to come back down some. And yeah, to the extent that if there's relief, some of the tariff impact really does kind of go away. If some of them have been ruled illegal, but I guess Trump is still trying to put some new ones on. I don't think that's going to go very far. That will help. Some of those products that were being pushed up in price due to tariffs will sort of come down some. I think, and some things like, price of eggs, which of course got a lot of headlines a couple of years ago, have come way back down. Orange juice, some other factors have come down in price recently. So there are some things that had been a problem maybe in the past, and that have, seen their prices either come down or at least stop going up. So I think you will see some of that. I think, consumers are having to pick and choose, what to spend on. And right now they're spending a lot on things they have to buy, like oil, energy, and then, things like going out to concerts and things like that, services spending. But overall, I don't know how much, declines in prices are going to be overall. Although even housing inflation, rental, prices in aggregate have been slowing down quite a bit for a couple of years now. And I think that's probably going to continue as well. Just from, less demand from, lower immigration, and the fact there has been at least some building going on, and the fact that mortgage rates are still relatively elevated, so that there's just less turnover in the housing market.
What do you think are some of the more interesting or unorthodox leading economic indicators that have some merit in theory and also in practice that you've seen?
Yeah, it's a good question. I think the traditional leading economic indicators have not worked very well the last, certainly 5 or 10 years. Um, I think right now, the biggest, leading indicator is going to be, technology spending for the economy. Most of the growth in what you call fixed investment in the GDP report has been tech driven. Everything that's not tech driven, meaning just normal like housing, residential housing, commercial office buildings, factories, anything outside of technology has actually been falling year over year in terms of spending on investment, things like that. So that's going to be the factor that changes. I don't think the yield curve and rates and things are as good a predictor as they used to be. And the other thing again is like I say, fiscal policy. The deficit being relatively wide is part of what is causing the factors we see right now. If we saw the deficit narrow, if we decided to cut the deficit and cut spending or raise taxes, I think that would be a pretty significant factor to watch for the economy. If we did ever reduce the deficit significantly in a short period of time, you would then see the economy slow down, I think, significantly. And if for any reason it expanded even further, that would be an additional boost overall.
Any sales of particular goods or services that would rise or decline during times of economic expansion or contraction? This is a tongue-in-cheek thing that's been featured in the media a lot. This is from CBC, by the way. What the stripper index can tell us about the economy. So apparently exotic dancers are a good leading indicator of whether or not there's going to be a recession. I don't know if there's any way to actually verify this, but that's circulating on the internet. Social media, people on social media have said that, oh, look, the exotic dancers I've talked to are all better forecasters than actual economists. I don't know. Anyway, that's just a tongue-in-cheek way of indicating that there are some goods and services that obviously will rise and fall alongside the contraction with the expansion of the economy, and perhaps even before we see official data. Anything comes to mind?
Yeah, that would be an interesting one. Yeah, there's always been a long history of things that kind of very discretionary items, I guess you'd say, that people choose to buy or not choose to buy. That are perceived as a leading indicator. Typically, when you dig into them very closely, you find that they don't really predict a whole lot necessarily. But to me, it'd be more travel and entertainment, basically the things that people are going out either to traveling, just for vacations, or going to concerts, or just going out to dinner, things like that. That's probably the factor that to me I think is probably the biggest kind of swing factor. People stop doing that. Then because during COVID people couldn't do that, and so for a couple of years, more recently, they've been really seems like trying to go out and do things and use this kind of sort of travel entertainment services. And so if that starts to slow down in a significant way, that would probably be a leading indicator as well.
On that note, I am looking up TSA throughput data, and I'm just going to get AI real quick to chart this. So this is, this just shows the number of travelers going through TSA checkpoints. It's June 28th, 2.9 million. What was it at the beginning of the year? I'm just curious here. Beginning of the year was 2.3 million. So it really hasn't changed a whole lot. I mean, a lot of this data is very noisy on a daily basis, but overall, I don't think we've seen a huge change on a year-to-date basis. Okay, so
there's been a lot of things going on with air travel, of course, but government shutdowns and TSA blockages and all that kind of thing, I think, affected things over the last 6 to 12 months. I think demand is relatively high. A lot of the airlines, if you look at their earnings reports and things, they'll say that they still have a lot of demand. They're dealing with oil prices, from a cost standpoint, but people still want to fly. And so I think there's that interest in it, and it's just a matter of whether people can, afford it, and whether the airlines themselves can manage it, given all the oil prices and everything.
Okay, very good. Thank you very much, Sam. Appreciate your insights. Where can we learn more from your work and read your insights and analysis?
Sure. So millstreetresearch.com is the website. There's a weekly report that we publish called the Weekly Roundup that you can subscribe to if you want to. There's a blog there that's free, which you can kind of check periodically for updates. And then I post pretty regularly to Blue Sky under Mill Street Research. So for just kind of topical comments day to day. So those are all good places to find the work.
Thank you very much. Appreciate it.
My pleasure.
And thanks for watching. Don't forget to like and subscribe and use my code LIN, L-I-N, when you sign up to Kalshi. New users will get $10 when you deposit $10. Link down below or scan the QR code here.